Good afternoon, everybody. Kiana here. We're going to start our webinar shortly. First, let me welcome everybody who have already joined us. We have Ed, Eduardo, Lalzada, Lawrence, Mike, Orlando, Piet van der Merve. I hope I'm pronouncing your name right. Roberto, Steve, Veronica, Melissa, Mohammed, and people who are joining us right now. Thank you very much for joining today. Our webinar is going to start momentarily. Before we start, I want to let you know that this is a live webinar. Please let me know if you can hear me. So if you can hear me, please type in a Y for yes right now so I can make sure everything is all right. And okay, great. Thank you so much, Veronica, Mike, everyone. Thank you for your response. So the voices working, that's great relief. And if you can see my PowerPoint presentation right now on the screen, it says creating Kiwi trading strategies. Just change it to higher risk investment. All right, so it seems everything is working all right. So in that case, let's get things started. All right. So today, before I start, let me just read this high risk investment warning that trading on margin can result in losses that may exceed your deposit funds. So make sure that you are in the right track with your financial health. If you are trading forex, which does involve a lot of risk, and if you do, if you are well sure about your finances, don't forget that trading on leverage can really be risky. So be aware of that. Create strategies that really are suitable for you and your financial goals. And if you have ever any questions about that, obviously, just write down and shoot down a question on the chat box down here. All right, so it's 1:01. All right, let's start. I'm going to wait a little bit for more people to join us. And in the meantime, I want to go over the main reasons why traders lose money. If you didn't know, over 85% of forex traders lose money, and it is hard to build a strategy that is consistently profitable. That is what I've heard from so many of my students, that one year they made a lot of money, and then the next year they started losing all of that. And so what should we do to be consistently profitable? So that is the main pain in the forex community crowd, and I get it. I have not been immune of that either. I have had losing trades. Everybody has had losing trades. Anyone who ever has told you they've never had a losing trade, they're probably not that probably experienced, let's say. And so when it comes to trading, if you don't have the right strategy, that even if you're losing, you can actually have a peace of mind, that is really going to have a huge impact on your emotional and well-being. A lot of traders have trouble sleeping when they are swing trading, or they have their positions open because they're scared that the market's going against them, and that has happened to me as well. And that is a real pain. So today we're here to really create strategies that is going to put you at ease, and even if the markets go against you momentarily, you won't have those problems of being really emotionally and financially affected by it. And one other fun fact that I've learned while being in this business for over 8 years is that majority of forex traders wipe out their whole account within 6 months. So today I'm going to again cover some strategies that will prevent you from becoming one of those statistics. We want you to become a profitable trader. All right. So on today's agenda, we first are going to have an overview of New Zealand economy. What is New Zealand economy? So Kiwi trading, if you are trading Kiwi, that basically means that you're investing in New Zealand's economy, because New Zealand's economy is represented by internationally its currency. So it is very important for us to get at least down to the basics of what New Zealand's economy consists of. what are their strengths, what we should be looking at, and where it's standing versus its other counterparts. And then, even though today we're going to, well, the title was Kiwi trading, I definitely want to take like a few moments talking about the highlights of the FOMC and the Bank of Japan statements that came out this week, because while trading currencies, obviously when you trade Kiwi, you're going to trade it against another currency. We're definitely going to cover Kiwi yen and Kiwi dollar. So for that reason, I'm going to also cover a little bit of FOMC and Bank of Japan. And next, we're going to get down to business and do strategy development for Kiwi crosses. We're going to try and cover at least 4 Kiwi crosses if we have enough time. And if you bring on your questions, hopefully I'll be able to customize a strategy for you right here. And at the end of the webinar, we're going to open for question and answer. So definitely make sure that you're going to stay until the end, because not only I'm going to open for questions and answers, I also have some really juicy, delicious goodies to hand out to you at the end of the webinar, and that is only going to be available for live students. It is not going to be available on the recorded replay. So with that, let me tell you a little bit about myself and how I got into this business. I got scammed over 10 years ago after making my first $10,000 as a college student. I was a student in Japan. I was studying electrical engineering. I was not in the field of finance, but I traded forex. I got lucky and I made $10,000 over my $10,000 investment. So I doubled my investment within a month. And however, because I was not an experienced trader, I thought that was just luck. So I decided to leave my money with a pro who approached me and was like, hey, I'm going to take care of your money. You don't know what you're doing. Let me help you. And well, at the time, I was also on Japanese TV, so I had some savings and I had a scholarship from the Japanese government. So this manager pushed me and convinced me to invest $100,000 in his account. And guess what? He ran away with it. And that is how and why I decided to get educated in investment and finance in general and take care of my own money so nobody can ever scam me ever again. And that is why I came to New York. I started working on Wall Street, and I learned, well, I worked on Wall Street at a forex broker and at a back-end forex broker and a liquidity provider, and I was on Forex TV. So I really know the industry in and out, and I published my book on forex about 3 years ago. I started Invest Diva, which is my company, 4 years ago, 4.5 years ago, I guess. And so that our main goal is financial education, online investing education platform to make it easy for everybody to understand how to invest. And right now, I'm a professor of finance at Baruch College, which is a university in New York. I have been featured, well, I was actually featured right yesterday on Forbes again for my pound strategies. I've been featured on Forbes, CNBC, Wall Street Journal, Times, CNN, and so on for my strategies. And our education courses have been winning a ton of awards in the past few years. So it's been an incredible journey, and hopefully I can help you today to develop your strategies that are going to be incredibly profitable and mind-blowing. All right, so are you ready? We have some new people who joined us since I welcomed everybody. So welcome all the new audience, and here we go. We're going to start on New Zealand economy. First and foremost, as I said, I'm going to just give you a well, general overview on what New Zealand economy is. So the New Zealand economy is a mixed economy. It depends greatly on international trade, mainly with Australia, European Union, the United States, China, South Korea, and Japan. And the fact, and one of the closest economic relations of New Zealand is with Australia. And this closer economic relations agreement with Australia means that New Zealand's economy is closely aligned with the Australian economy. So if you hear something about Australian economy, Australia's economy is not doing well, you probably can assume that maybe New Zealand's economy is going to go down with it. They're aligned, just like the pound, British pound, and the euro are aligned, right? So these are the down under countries. And I know the map of New Zealand kind of looks like a reverse of Italy's. New Zealand's like a boot reverse, a heel boot reverse. I don't know, I'm probably being really girly, but so yeah, so it is an island very close to Australia. And so New Zealand's economy has a sizable service sector, which accounts for 63% of all of its GDP activity. Well, that was actually back in 2013, and right now it's more or less the same. And the large-scale manufacturing industries include aluminum production, food processing, metal fabrication, wood and paper products. And on the other hand, some of the services that account for almost 16% of the GDP are mining, manufacturing, electricity, gas, water, and waste services. And so these primary sector continues to dominate New Zealand's exports, despite the accounting only 6% of the GDP. So that is why we really look at those data as well when it comes to New Zealand. Dairy is another one that we look at. I'm going to explain about that a little bit later. All right, so these are the stuff that affect New Zealand economy. So how has the New Zealand economy been doing in the past month? All right, for that, I'm going to take you to the economic calendar shortly, but just for the headlines, so what has been going on? So we had the GDT, which is the Global Dairy Trade Price Index. This has been falling in September. We had 2 consecutive falling outcomes in September. Most recently was 2 days ago that it dropped from 7.7% to 1.7%. That was on September 20th. All right. We're having more people joining us right now still as I'm talking. So newcomers, remember, stay until the end of the webinar when we open for question and answer. All right. Back to New Zealand economy. We had the GDP. So the GDP came in on the annual basis, it was unchanged. On the quarterly basis, it grew. I'm sorry, on an annual basis, it grew. On a quarterly basis, it was unchanged, but both of them were lower than expected. So that created a little bit of volatility, and the bearish sentiment that we're seeing within the Kiwi crosses today was because it was lower than expected. And I'm going to explain to you what this lower than expected means and how you should be implementing it in your strategy, in your medium-term, short-term, and long-term strategies. Does it matter, this lower than expected? How much does it matter? How long does it matter? We're going to explain that. All right, and another big news out of New Zealand was the interest rates. The interest rates were unchanged, and the RBNZ kept the interest rates at 2%, which is a pretty generous percentage of interest rates, right? If you compare it to, let's say, the negative interest rates in Europe or in Japan, or the mere 0.25 to 0.50% interest rate in the US, this is actually pretty high. So a lot of people, not a lot of people, we are expecting an interest rate cut at some point, but well, this time they kept it unchanged, and but the high New Zealand dollar and the this inflation that is actually kind of becoming an issue for New Zealand might soon spirit into a rate cut. When? We still don't know, but economists polled by Reuters have widely expected the RBNZ on the decision of not cutting the interest rate this time. But so one thing to remember, though, is that in the policy statement, the RBNZ did leave the doors wide open for a cut later this year. That leaves us with only what? We're September right now, October, November, December. So within the next 3 months, there is a high possibility of a rate cut from New Zealand. And what does that mean? How could that affect the New Zealand dollar? Obviously, it is going to have a downward pressure on the New Zealand dollar. So you want to keep that in mind. That is one of the main things that we want to keep in mind. And another main thing that you want to keep in mind is that because the RBNZ left the door wide open, one main issue is that well, everybody knows about this news. All the traders, all the investors worldwide know about this news, and that means that we could see the Kiwi be under pressure even before the rate cut. Which means that is the classic sense of the markets being priced in, right? So because everybody's expecting a rate cut, the Kiwi could go lower just because of the expectations. That is a speculative analysis. All right, talking about speculations. Right now, let's actually take a look at a speculative sentiment index for New Zealand. And how that works is that you look at some of the major brokers. Well, Orbex also provides that to some of their partners. So how that works is that you look at Kiwi, the ratio of long to short positions and Kiwi crosses, and see how many traders are long and how many traders are short. And you want to use this as a contrarian indicator, meaning if more people are long, that could give a bearish signal, vice versa. I'm looking at that right now, and it seems like for Kiwi dollar right now, 46% of traders are long, 43 right, and it is actually the long positions are decreasing. That is actually giving a little bit of a mixed bias on the market sentiment. So yeah, today, unfortunately, that is not giving us a good reaction on that, a good indication on that. All right, so that is that for New Zealand economy, the latest, the basics, and all that. And next, as promised, I want to take a few minutes talking about the major highlights first of the FOMC statement. So what happened is that, well, number one is that the FOMC members voted to maintain the policy. 6 of the meetings down this year, and now only 2 more to go, and still no rate hike from the Fed. And the Fed did say that the case for an increase in the federal funds rate has strengthened, but decided for the time being to wait for further evidence of continued progress towards its objective. So to make it short, the Fed is still in the wait-and-see mode. My guess is, well, guess what is the main topic in the U.S. right now is the presidential elections, and it will be a little bit of, I would say, what is the word I'm looking for? It will be irresponsible of the Fed to raise the rates, I would say, before the elections, because right now the markets are in a bit of a turmoil on the speculations of who is going to become president, and for that reason, I think they're being a little bit more cautious on that. And Janet Yellen, in her speech, she explained the reason for the Fed's lack of action as okay, I'm going to quote her here. So she said that, so why didn't we raise the federal funds rate at today's meeting? Our decision does not reflect a lack of confidence in the economy. Conditions in the labor market are strengthening, and we expect that to continue. And while inflation remains low, we expect it to rise to our 2% objective over time. But with labor market slack being taken up at a somewhat slower pace than in previous years, scope for some further improvement in the labor market remaining, and inflation continuing to run below our 2% target, we chose to wait for further evidence of continued progress toward objectives. All right. And then another main takeaway from the Fed statement was the downgrades, the economic downgrades. They downgraded the GDP growth projection for 2016 from a median reading of 2% to 1.8%. And Janet Yellen said that the downgrade was a result of the weaker than expected growth seen in the first half of the year. However, on an upbeat note, the median GDP growth projections for 2017 and 2018 were maintained at 2% each. But then again, on another downbeat note, the longer run growth projections were downgraded from 2% to 1.8%, and to be moderated in a bit in 2019. So it's a little bit mixed on a longer term. Unemployment was also downgraded. Jobless rates was at 4.9% in August, and according to the Fed, it's expected to tick lower to 4.8% by the end of the year. But as you can see, the Fed's median projection back in June for jobless rate was 4.7. So they downgraded that to 4.8, and so Janet Yellen blamed this downgrade to the persistent slack in labor market. And then inflation forecast for 2016 was also downgraded from the median rate of 1.4% to 1.3%, but the forecast for 2017 and 2018 were kept at 1.9% and 2% respectively. And so the lower inflation projections for 2016 was attributed to the lower inflationary pressure from domestic demand, again, due to persistent slack in the labor market and weaker than expected economic growth. So these were downgraded. So that was a little bit of that provided a little bit of a pressure on the U.S. dollar, because, I mean, they are saying they were confident, but they're not confident enough to have those massive forecasts. But that is good for us. Why? Because now that they have downgraded their forecast, if these like inflation, GDP, and unemployment come better than this forecast, then that is going to be incredibly good for the U.S. dollar strength. All right. So I think this is basically politics that are playing on us, which is not bad, right? And so one more thing is that they are again saying that there is going to be a slower path to tightening, and they projected that there would be room for 3 to 4 additional 0.25% rate hikes in 2016 when they finally hiked back in December of last year. But the global risk factors and the economic developments didn't evolve the way the Fed expected, and so they downgraded the projections to just 1 to 2. That was back in March, and then later they maintained that we can expect 1 to 2 hikes in 2016 in June, but then they downgraded the projection for 2017 from 5 to 6 hikes to just 4 to 5. And right now, so the Fed also downgraded their rate hike projection for 2018, the same meeting, from 10 rate hikes to just 7 to 8. So we're going to expect a whole lot less rate hikes from the Fed in the coming years. And yesterday in the FOMC meeting, they did it again. This time, they lowered the projection path of monetary policy in 2016 from June's 0.9% to just 0.6%, and with the current federal funds rate at 0.50% at this as a starting point, that means that the Fed is now expecting only 0.25% hike, or even none at all for this year. So that is down again from June's projected 1 to 2 rate hikes. And so these were obviously not really good news for those who are looking forward to a rate hike. And how did the U.S. dollar react to this? So it's initially it dropped, and then it kind of gained ground across the board. So we're going to actually look into the technical analysis of that. Before that, let's also take a look at Bank of Japan highlights. So we had the BOJ out 2 days ago, and they finally announced the results of their comprehensive assessment as well as a new policy framework that caused the Japanese yen to drop quite a bit, right? So first and foremost, they were acknowledging their inflation problems, and they were saying that they're basically blaming inflation problem on weakening inflation expectations, and they said that expectation formation in Japan is a backward looking. So, I mean, if you don't understand what that means, well, what you should know is that inflation expectations mainly affect how companies compensate their employees, as well as how they price their goods to a certain degree. If inflation expectations are to the downside, for example, then companies will generally avoid increasing the price of their products, and they won't be very open to giving their employees a raise. And both scenarios naturally contribute to worse inflation levels. So Bank of Japan acknowledged this persistent inflation problem and judged it necessary to adopt measures that will raise inflation expectations in a more forceful manner. And that is why they introduced a new framework that also has a title that is called QQE with yield curve control. I'm not going to get into that, but this new framework has two components: the yield curve control and the inflation overshooting commitment. And a little bit too hard to explain right now, so I'm not going to get into it because today we're not going to talk about Japanese yen. I just wanted to let you know. And but things that are important with Kiwi yen is that you should know that Bank of Japan is not going to give up. And they still have some tricks up their sleeve. They might cut the short-term policy interest rate at some point, cut the target level of the long-term interest rate. They might expand asset purchases. So anything that they can to weaken the Japanese yen. All right, so here we already went over most of the fundamentals that we need today for our trading analysis. All right, any questions? Write it down as you think of it. I'll go over it at the end of our session. All right, so now I'm going to go over to our we're going to go, can everybody see the screen? This is the time that you want to come back to the screen if you were on Facebook or something and not paying attention. This is the time that you really want to pay attention, all right? For those of you who don't know, this is investdiva.com. Definitely go on here, sign up. We have daily updates and videos and a lot of fun stuff that you can subscribe for free. And this is today's Kiwi yen trading strategy. And here I'm going to go and open up our chart, right? Okay, so over here we're first going to take a look at Kiwi dollar and see what is looking delicious and what's not looking delicious. We're going to zoom out from the monthly chart and then come back down to 4 hour. All right. So this is the monthly chart. This is a very long-term overview. All right. So what has been going on with the Kiwi dollar since 1994? What is the medium range? And what general trend can we see? And what general cycles can we see? So as you can see, the cycle is not really consistent. It has been actually moving up within the past, well, 20 years. We have the higher lows, well, moving higher and higher in each cycle. By that, what do I mean? The lowest low was back in 2001 at around 0.39, which is pretty low, right? Then we had the next low around 2016 was at around 0.60. The next low, well, this cycle, actually I wouldn't look at this as a low. I would look at that as a double top pattern. The next low was right here after the market crash in 2008 through 2009. It went back up again. And now, look at this. Should we or should we not consider this as a new low? So that is the question for a long-term perspective, right? And the reason why I say that we still don't know if this is actually the new low is because, look, back in 2006, the market did come down all the way here, and then it went back up, and then we had a lower low after that. From here, this means that, this level, looking at Kiwi dollars, well, history, it looks like, well, at least temporarily, the market has bottomed out. And this certainly is the new uptrend. But as you can see, we are still below the Ichimoku cloud on the longer term point of view. So that means that we could, and the Ichimoku cloud, if you look at the forecast, is turning red, right? So that kind of put a cap on our bearish position on this, especially since right now the pair is testing this level, which is a very important level. I'm going to paint this one orange. Why? Because look, this was in 2005, this was a resistance level. In 2009, the pair will consolidate it, and this was again a resistance level. So this definitely is an interesting and very important level. Another thing I would like to use on the monthly chart, just so that you can see the new levels after the previous, well, downfalls, is the Fibonacci retracement level. And as you can see, well, 38% sort of actually falls right on where we have selected as our pivot, right? So this is the zone. This is our pivot zone at the moment, right? And then we have the 50% Fibonacci right at the upper band of the Ichimoku cloud. So this is our long-term resistance level. So our very long-term outlook, right, on the monthly chart. This is a monthly chart. Each of these candles were taken 1 month to develop. So if you look at this from the monthly chart point of view, we still don't have, it pretty much is mixed. I won't go fully bullish on Kiwi dollar unless it breaks above the Ichimoku cloud, or at least above the 50% Fibonacci level, whichever comes first, right? And right now we're kind of in a wait-and-see mode, right? Even though we said that, well, Kiwi could be under pressure, and well, making it fundamentally also making the fundamentals and bringing the fundamentals into the mix. We said that, well, Kiwi could be actually under pressure because of that rate cut in expectations. So this new trend of upward movements could be short-lived. So I wouldn't be in a long-term position on Kiwi dollar at the moment. I am a long-term trader, and by a long-term trader, I mean like being in that position for 6 to 1 year. I do not have enough indications for that, so I'm not going to, if I'm going to trade Kiwi dollar, I'm going to trade it on a shorter term time frame. Let's see if we have any indications. I'm actually going to open a new chart so that we can keep the monthly and come back to it later. All right, so I'm going to open a new chart for Kiwi and do the monthly. All right, I'm going to delete the Fibonacci because it makes it a little bit too colorful. All right. So on the daily chart, however, well, we can very vividly see this new uptrend. The pair is definitely above the Ichimoku cloud, right? And then we have our resistance level at 0.75, right? But again, the question is, do we have any new bullish signals from this pair, right? Let's take a closer look. Closer look on this new uptrend, again using the Fibonacci retracement level. Yeah, this is not again giving us any indication. So instead, from a technical analysis point of view, I'm going to use a channel. Let's see if it actually fits within a channel, right? Pair obviously is moving within a channel, kind of, right? And it hasn't really broken above or below it, right? So one thing that we could say from this, so what we learned from the monthly chart was that we cannot be in a very long-term trade. One thing that we could see from the daily chart is that we could actually see the market has been zigzagging almost, not quiet within this channel, but actually the real resistance level is a little bit higher, not this one. The real resistance level is the upper band of the Ichimoku cloud at the moment, right? So this channel could be kind of distracting. Only the upper band is more important. So I'm going to change that channel into a trend line, right? So I'm going to put this is our upward trend line over here. I'm just showing you how I come up with conclusions. Like, you check out with as many technical tools as possible to see which one really matches and fits the current chart, right? So we saw that the channel didn't provide much information, so we changed that just to upward trend line, not a trend line, resistance. This is not a trend line, this is a resistance, an angled resistance level, right? So the angled resistance level, it crosses over our horizontal resistance level, which is also a Fibonacci retracement of about 0.75, right? So there is so I would say if you were to trade Kiwi dollar on a daily time frame, which is somewhere, if you want to be in a Kiwi dollar position for somewhere between a week to 3 months, that is when you use the daily chart. And with that, I would range trade. Right now, we're right at the pivot level. So you could either go up or you could go bullish or bearish. If you go bullish, you can target either, depending on your risk tolerance, either this angled resistance level, right? So depending on your time frame, if you want to stay in the market for another, let's say until November, you're going to target this 0.76. If you want to get out, let's say in October, you want to target 0.75, right? Or if you want to get out, if you don't want to have a time horizon and you have lower risk appetite, I would go a little bit below 0.75. So let's say 0.7450 or something, just to ensure. Like right now, I would say the best bullish target for Kiwi yen based on a range trade is 0.7450. I'm going to correct this here. $0.7450 is our medium-term bullish target. All right. And if you want to say, okay, so today, obviously, the Kiwi dollar is on the bearish mode, market sentiment-wise, and it is, again, testing the pivot level. If you want to go bearish and trade within the range, then you want to target the upper band of the Ichimoku cloud. And as you can see, the upper band of the Ichimoku cloud is actually going up. So that is going to be a little bit harder for now. So I would target no lower than 0.72. As I said again, Kiwi dollar pair right now is not really giving us strong bullish or bearish signals. So the best bet for you is range trading on a daily basis. All right, so let's take a look at the 4-hour chart for Kiwi dollar for shorter term traders. So this proves that the mixed signal, the market, the pair is already inside the Ichimoku cloud. Again, we don't have any concrete signals. But for a short-term trader, what do you want to do, and what are you going to wait for as a signal? So first, for a bearish scenario, now you want to tighten your targets. For a bearish scenario, I would again use the Fibonacci retracement levels to create my targets. So as you can see, the 38% Fibonacci level is right here. That is going to be another pivot, right? So I would say it is pretty safe for the pair for you to say that the pair is going to reach 0.72, but it's not really safe. There is going to be almost an 80-20 risk reward over here. So 80% risk with 20% reward. All right, so with that, because even right now, the pair, even though we've been having a downward pressure, the pair has been on a shorter time frame moving in an upward parallel channel. You see this one? A lot of mixed scenarios going on right now, right? So again, the best bets to trade Kiwi dollar on a 4-hour chart also is to range trade it within this upward channel, right? So this is your downward resistance, this lower band of the channel and support, and the upper band is your resistance. All right, so when are we going to have a concrete bearish signal from the pair? Only if the pair does break below the Ichimoku cloud on the 4-hour chart. That is your first signal, and your first target is going to be at 0.72-ish, so I would bring it a little bit higher. You want to loosen up your target a little bit, so that is going to be your first bearish target. A bullish target, a concrete bullish target, is going to be a break above the 23% Fibonacci level and the Ichimoku cloud. Your first bullish target is going to be at 0.7450. All right. So next, we're going to take a look at Kiwi yen. Everybody okay with a Kiwi dollar? If you have questions, write them down. I'm going to look at them at the end of the webinar. And I can see that people are actually writing the questions. So be patient. I might cover it before I get into the Q&As. All right. So this is Kiwi yen. All right. So Kiwi yen. I actually wrote my strategy today about Kiwi yen. Today, this is the daily chart. But before that, again, I'm going to look at the monthly chart and zoom back in a little bit. So this is different. Kiwi yen chart is different than our Kiwi dollar. And the cycle is a little bit less symmetric or repetitive. Right, and so our first cycle completed between 2001 until 2009. And the second cycle seems to be completing right now. And the pair right now is within the Ichimoku cloud. So again, another consolidation, right? And we definitely have opportunity for the pair if the bearish momentum continues to even reach the lowest levels that the Kiwi yen has ever reached back in 2009 in 44. But, well, that is pretty harsh. Well, I'm not saying that this is going to happen because, well, 2009, we had a world financial crisis. At some point in the next 10 years, that might happen. But, well, that is basically a line that you want to keep in mind. Look, because our higher highs happen to be the same height, almost the same height. So back in 2007, the pair reached 94, and then again, back in 2014, the pair reached almost 94. So almost the same zone, right? So that is why we could expect the pair and the movement of the pair to the upward is almost similar to this uptrend over here. So every chart tells us a story and habits and cycles of a specific currency pair. So that's why you cannot say technical analysis is the same across the board for every currency pair. Every currency pair has to be treated for its unique movements. So really keep that in mind and try to find patterns with each and every currency pair individually. As every person is unique, every currency pair is also unique. All right. So I'm going to do, again, a quick Fibonacci retracement analysis on this. All right. Just to see our major levels that we need to keep an eye on. So we have the 50% yet to be broken, and currently the pair is testing the 38%. So that is a very interesting discovery right here from the Fibonacci retracement levels. If you're not familiar with Fibonacci retracement levels, I have a souvenir for you that I'm going to share with you at the end of the webinar. I love Fibonacci and combining it with Ichimoku, and it really helps me with developing my strategies. All right. So right now the pair is testing the 38% Fibonacci level is within the Ichimoku cloud, and we have the 50% Fibonacci, which is the most important Fibonacci level of them all, below the Ichimoku cloud. The pair did test below the Ichimoku cloud. It didn't break below it. Right now has been ranging. All right. So again, here we don't have any long-term signals yet, right? Our first signal would be a break below the Ichimoku cloud, for which our first support will be our first target of 69.50-ish, right? And if the pair breaks, again, above the 38% Fibonacci level, we still don't have a concrete bullish signal unless the pair breaks above the Ichimoku cloud. So right now, I would say the sentiment is mostly bearish, but rather mixed. All right. So next, we're going to take a look at it from the daily on the daily chart. The daily chart, again, we can, well, the consolidation is very vivid again in this pair. Right. I'm going to mark the Fibonacci retracement level so that I can remove it, because these colors can be incredibly distracting. I know that. These are 38% Fibonacci, and then I'm going to remove the levels over here somehow. All right. So here I'm going to again use another Fibonacci retracement level for our new levels. And so here, we don't really have a trend. It's very hard to use Fibonacci over here, right? So we have to rely on something else. What else is happening over here? One of my students yesterday told me, oh, this is a double top. This is not a double top. A double top is a formation within an uptrend. We did not have a real uptrend on the daily chart. If you look at it from the 4-hour chart, yes, this might have been a uptrend, but this is not a real uptrend. I mean, after the pair massively dropped 69, you can see it as an uptrend, but it's not really an uptrend. Anyway, so I wouldn't say this is a double top pattern, but we definitely have a support level right here at 72, which, if the pair breaks below the Ichimoku cloud, which it didn't, it tested the Ichimoku cloud today within the past 24 hours and wrote about it. It has been very indecisive since last week. This is a massive spinning top candlestick formation. Everybody can see it. So after this, what happens tomorrow is what really matters. We have a very vivid spinning top. Like this is the best spinning top that can ever be formed. It's like, it's symmetrical. Like if you wanted to learn about spinning tops, this is it. This is a real spinning top. And what happens after a spinning top is what really matters. After a spinning top, if we have a massive bullish candlestick that breaks above the Ishmael cloud, that is going to change our outlook into bullish, of course, because that is going to be a bullish engulfing. Our first target is going to be 75. After the spinning top, if the market is massively bearish that it breaks below the Ishmael cloud, of course, our target is going to be our forecast is going to turn to bearish, targeting 72.43. Right now, again, we are at the wait and see mode. We could not be more of a wait and see mode. We are right in the middle of the Ishmael cloud. We have a spinning top in the middle of formation. We have absolutely no signals on Kiwi yen. So it is interesting because I thought, I mean, today, well, we chose this day for Kiwi yen trading about a month ago, so there was no way for me to know what exactly is going to happen on the day. So unfortunately, today is a wait and see mode, but you can obviously write it down. Definitely write down these notes. If the market, everything depends on the next candlestick on the daily chart, which is tomorrow. So right now is around 6 p.m. GMT. We have another 6 hours at the end of the day, but so the Sydney session Friday is going to start in about 6 hours, and that is when that candlestick is going to be our indication. So tomorrow, still, you're not going to trade. Tomorrow, you're going to wait and look at the next candlestick formation. Monday is when you might have an indication. But you might even not have an indication on Monday, because guess what? We might have another spinning top formation on Friday as well. So this basically goes on until the wait and see mode is canceled. The pair has broken above the Ishmael cloud. A decisive candlestick formation is formed, and then you can target again short term, short term, short term. We cannot go long term when it comes to I'm looking at the questions. Oh, a lot of questions. All right, I'm going to answer your questions in just a moment, all right? So let me just finish my thought. My thought was that, yeah, when it comes to trading, all right? So when it comes to Kiwi yen, we cannot go on a long-term perspective right now. And one of the questions that I just glanced at the questions is about how reliable is long-term trading. It's a great question. I'm going to answer it in a little bit. But first, I want to also go to the 4-hour chart and see if we have any sort of indication over there. So on the 4-hour chart, as you can see, the pair is already below the Ishmael cloud. So if anything, the market sentiment is perhaps more towards a bearish momentum. Again, let's see if we have any indication. So here, at least, we have more of a trend going on in the 4-hour, right? So with these indications, we have the pair just broke below the 61%. So we have actually a little bit of a signal over here. It's below the Ichimoku cloud, the Tenkan line. Let me see. Yeah, so the Kijun line broke below the Tenkan line and the Ichimoku cloud, and the pair broke below the 61% Fibonacci. Can you see it? Right now we're at 73. So the Kiwi yen broke below 61%. So we have a little bit of a bearish signal over here, right? And today, basically, the reason why on the daily chart we had a spinning top is because, look, it went down and then we went back up and it came back down. So it's been testing this range. So a sure bet, I would say, for Kiwi yen on a 4-hour chart is, now it's still not short, but I mean less risky bet, let's say. It's definitely not short. A less risky bet again is a short-term bearish, targeting 73.50. Extended, depending on your risk tolerance, if you want to stay in it longer, is targeting the 78% Fibonacci at 73.18. All right. So we have a little bit of more of an indication when it comes to Kiwi yen, but we don't have any immediate, concrete, technical indications. The only reason why, there are two reasons why I pointed out the bearish scenario or the strategy. One is the fundamentals that we just talked about. That, well, Japanese Bank of Japan didn't do anything. They might do something next month, but, well, we didn't have anything out of it just yet. And we might expect a rate cut from Kiwi. So the bearish scenario, because of the fundamentals, is a little bit of a heavier way when it comes to yen. All right, so now it's time to go back and answer questions. We're going to answer questions, but before that, I just wanted to, because you've been such good audience, you've been asking questions, you've been remained with me until the end, I'm first going to offer you a massive, crazy, only 45-minute available discount on our beginners video course. So what this is let me just give you an overview of what we offer on investiva.com. So we have all these stuff. We have beginners video course. Well, wealth management course is coming up. Not yet. We have risk trading signals that is for experts and really committed traders. And well, the private coaching is something that I really, really, really encourage you to take before you get into trading, because everybody's different. You're financially unique. And then we have the HMO Secrets that is coming up. But today, my gift to you is a discount to our 30-day of trading, the Forex coffee break. I know some of my students, some of you today have actually already taken the course. Thank you so much for being here, and thank you so much for coming back to the webinars and taking the class. So just for those who don't know about this is a 30-day of training, 100 videos. It's for beginners who want to learn about what Forex is, want to learn about technical analysis. This is me dancing. Well, all the videos are presented by me, were edited by me. Everything was done by me, and they're pretty fun. And so you can watch them basically during your coffee breaks every day. 3 videos per day is going to come to your mailbox, and after the end of the 30 days, you're going to become a master of trading. Also, you're going to get my trading alerts. So these are all the bonuses that you're going to get with this. On the Facebook page, we have a very premium Facebook page closed that is worth $299 per year. So you're going to save that. And if you ask me any questions, you're going to get answers on the Facebook page. And also, more than that, we have all these awesome stuff that I'm going to have you go over them. You're going to have free entry to all of our Investiva live events, whether in person or online. All of them you're going to get in for free. And another bonus is the stories of how I made $10,000 that I talked about at the beginning of the webinars in less than a week in college, and how the heck trading is different than investing, and how to use an economic calendar, and all of that. And these are some of our happy customers, people who didn't know anything about Forex, people who were independent Forex traders but learn more about it. So normally this is $997, but guess what? I have a discount code for you that is going to be available only for 45 minutes. So if you check your Q&A right now and click on that link, you're going to get that discount. It's 75% off, and it starts right now, as you can see. So definitely try it out, read a little bit more about it, look at the videos, and really, 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 I think this is going to be great for you, especially not only the videos, but being a member of Investiva and an insider for life is the biggest thing. All right. So now I'm going to go over our questions and answers. If you have any questions also about our course, definitely let me know. But we had a question from Veronica. She asked, how reliable is long-term investment since the economies and the central banks are all struggling globally? Very good question, and that was exactly my point, right? So because right now a lot of economies are struggling globally, and well, not most of the currency pairs are actually ranging, and that's why some of the long-term investments need to have really realistic goals. When we talk about a long-term investment, let me actually bring the chart up, right? So a long-term investment doesn't necessarily mean that you have to target a very massive or large target. So for example, I'm not saying a long-term investor should be targeting, let's say, for Kiwi dollar should be targeting 0.69. A long-term investor, you can like right now, today, go ahead and target a short-term target, let's say 0.7280, but you need to have enough leverage, enough margin, enough money in your account that if this strategy doesn't go in your favor, you can still remain until the market comes back down. So Veronica, I really want you to understand that what really is important about currency trading is that it moves in cycles. So what goes up must come down, what goes down must come up. So as you can see on the monthly chart, and the reason why I look at the monthly chart is because, look, the market has been, if you stick with the range of the market is sure to meet every 10 years, you basically, no strategy is ever wrong. So if I go bearish right now and target, let's say 0.68, I might not make money immediately tomorrow or next month or next year, but I'm definitely going to make money in the next 10 years. So in that sense, long-term strategies for Forex are actually the only sure way to make money in Forex. And those brokers who make you, who push you to trade, day trade or scalp, guess what? Well, Oryx actually is great with that because they have been putting a lot of emphasis on education enough. All right. So let's say, I mean, I know that we've already up with our with time, but let me just read some of the questions and the comments. The webinar is very good for us so that we don't place wrong trade and make losses. So we are very thankful for your time. Thank you so much for your comment. That really means a lot to me, and I really hope that I've been helpful to you today. If you have any questions, let's go back to our presentation here. So we're already out of time. Definitely take a look at what I showed you before. If you have anything that you want to tweet at me or connect with me directly, follow me on Twitter, Facebook and YouTube, or get my book, Investor's Guide to Making Money Forex, is a best-selling book. And of course, if you have any questions, recommendations for webinar, or things that we didn't cover today that you like, topics that you want me to cover next month, send an email to Oryx, info@oryx.com, and they're sure to get back to you or give your recommendations to us. Thank you so much, everybody, for joining us and sticking with us until the end. I'm very, very happy to see that everybody stick today until the end of the webinar. And yeah, invest responsibly, and I'll see you soon.